revaluation. Let's look at a plant that has a cost $100 and company uses straight line method of depreciation. Useful life is 4 years and the residual value is 0. And the tax office follows the same depreciation values and the rates. So at the end of the first year, the carrying value is 75 and the tax base is 75. There's no difference. There's no taxable temporary difference. Second year, 50 tax carrying value and the tax base. And third year, 25 carrying value and the tax base. And fourth year, 0 carrying value and the tax base. So there are no differences between the carrying value and the tax base across years. No taxable temporary difference means there are no different taxes. Let's look at another scenario. In the first year, carrying value equals the tax base. We are using the same asset. No taxable temporary difference, no deferred taxes. Beginning of the second year, company revalues the asset and revise the carrying value from 75 to 90. Tax base is 75. Now the asset value is greater, that means company is richer, and the tax office doesn't know if company is richer, must pay taxes in the future. And that difference is a taxable temporary difference, and that's 50. And 30% of that is 4.5. Next year, carrying value is 60 and the tax base is 50, temporary difference is 10, taxable temporary difference. And 30% of that is the deferred tax liability, it should be 3. Now, in the previous year, we recorded a deferred tax liability of 4.5, and now in 2014, it is 3. So the deferred tax liability has decreased. So we need to debit deferred tax liability 1.5 to bring it to 3. Third, next year, after revaluation, the second year after revaluation, carrying value is 30 and the deferred tax, the tax base is 25. The difference is 5, taxable temporary difference. 30% of that is 1.5. Previous year, deferred tax liability was 3, but it should be 1.5 now. So we need to decrease deferred tax liability 1.5. There's that difference. And then next year, carrying value is 0, tax base is 0. There are no taxable temporary difference. It should be 0. But we are having deferred tax liability balance of 1.5. We need to decrease that to 0. We debit deferred tax liability 1.5. Now, having said all that, let's look at the journal entries from revaluation. First, prepare for revaluation. Debit accumulated depreciation, credit planned cost 25. Conduct the revaluation. We need to increase the 25. Debit planned cost 15, credit revaluation surplus 15. Third, record the tax impact. So the carrying value is more, company is richer, it's a taxable temporary difference, and 30% of that is deferred tax liability. Credit deferred tax liability, and debit revaluation surplus, not income tax expense. There are three ways to explain this. Revaluation is an entry done on the balance sheet. So any tax adjustment for that revaluation should be done on the balance sheet. Revaluation does not give rise to immediate cash inflows. So the revenue does not increase immediately. So profits don't increase immediately. So income tax expense does not increase immediately. Third, revaluation is unrealized earnings. All earnings on the balance sheet are shown after income taxes, after taking away the income taxes. So should revaluation surplus. So we should take away the taxes part. So we debit revaluation surplus. Let's look at after revaluation. We did the revaluation. What happens? So the company must now record its accounting depreciation. The new carrying value is 90. The remaining useful life is 3. So we must take the new carrying value. And the new depreciation expense is 30. So debit depreciation expense 30, credit accumulated depreciation 30. See here, depreciation expense increase. Expenses increase, that means profits decrease, that means income tax expense also should decrease. 30% of that is credit income tax expense. This accumulated depreciation means depreciation is accumulating, that means asset value is decreasing. When asset value decreases, the deferred tax liability also must decrease. It decreased by 1.5. If you want more detail, 5, initially it was 4.5, and now the deferred tax liability balance is 3. We need to decrease the deferred tax liability by 1.5. That we can work it out by looking at the previous entry and work it out. That this is the entry for the deferred tax liability. Debit deferred tax liability 1.5 and credit income tax expenses 1.5.